Hello and welcome again on Stocks Advisor channel. Today we will talk about Humanigen Incorporated, ticker name HGEN, traded at Nasdaq, so healthcare biotechnology company, with a reasonable market capitalization of 1.18 billion and traded volume today is a little bit higher than 1 million, still within the range and making really nice 8.77%, finishing 2009. So the question is, what's next? Will it continue or not? Because looks like we are about to open the stable growth regime, means that so the stable growth means that you have the price on the top going all the way, and then you have your moving averages 20, 50 and 200 below, and moving average 20 works as a support line all the way. So looks like to be forming, looks like to be brewing here after some long, let's say, consolidation kind of move between the channels of let's say about 22 and the lowest one being 12, so really incredible, almost 50% window here. But now the question is, are we finally starting to grow? Because there are still some lines indicating that it might be indeed the case. So this trend line looks to be confirmed, although was 2 times kind of pierced but still recovered. Well, this might be forming. Another possible pattern here is kind of smashed or skewed cup and handle, because this looks like a cup and then looks like a candle formation. So at least we could go to 22 higher, which will make for us at least to do higher resist level, which is forming here at about 24, let's say 24.70. So there are multiple small resist levels. So still there is a possibility to immediately make up to 10%, and the longer term even more. So therefore the profit taking advice here would be from 10 to 15% from the money allocated in the position. And overall expectation is that we are about to start the stable growth regime, because if you look at the bigger scale, indeed it looks like we are kind of continuing to go, so we might be indeed confirming this. Although these 2 levels of resist that we just discussed, they were also seen previously in June, August trading, and yeah, it might be also the limit. So we need to keep this in mind as a risk mitigator. Therefore, as I said, we can aim the profit 10 to 15%, and the first call out, so the first primary technical channel where we can buy will be actually next. It will just here at 2012, and a lower part of it will be at 1790. So let's write it 1790, and 2012 will be the first technical level to buy full. So it's our first call out. We can write it here for ourselves. So this is the primary technical pattern which is expected to work first. So it's a finalization of the handle of this cup and handle formation. And then 10-15% you can take the profit, re-enter if needed, exit in time, take your profit in time, never hesitate to take profit, always do it in time, otherwise the position might expire and you will be actually losing your money instead of making a profit. So with this being said, this is the first technical, the primary technical channel. If it is cancelled immediately and we decline all the way, well, that would be quite unfortunate, but is also possible. And then the level of 1257 will work as a very nice support line, but before that there will be channel opening to buy through, and this will start here. So it will be something between 1257 and 1427. So if the first positive technical channel is declined, then we will have to actually prepare for averaging down at the lower levels, and this will make for us 1257 to 1427. So this is the secondary technical channel where we can still buy and prepare for rebounds, again making 10 to 15% profit from the money allocated in the position. And then the last one, as we always discussed at our channel, it's a risk mitigation. So what does it mean? It means that we want to mitigate all possible risks, and the way we provide opinion in these videos is actually we look at the technical pattern, we recognize the situation, then we recognize the first or the primary technical pattern that is about to work. This defines us first entry level. Then we recognize the secondary technical pattern. So if the first one is cancelled, what might happen then? This is the secondary technical pattern, the channel that you see. And the third one, we always want to keep some funds to average down if there is any unexpected, unanticipated negative catalyst which might come in form of bad news, global market situation or whatsoever. Because we don't talk about stop loss, we don't do stop loss, but we still want to exit with a profit. For this, we need to recognize principal levels and be ready to buy if the price declines. If this is going to happen here, well, in this case, this principal level will be obviously this one. It's between actually 992 at the top and 895 at the bottom. So this is our risk mitigating. It's not that we expect the price to go there. It's very important because sometimes people keep asking, why do you think it's going that low? Well, it's not that we think it's going that low. We want to keep some funds to buy there if it goes that low. So it's a little bit different philosophy. We just want to be sure that we exit with the profit from the trade, and in the worst case scenario, at least with the draw. So we don't want to see any red numbers in our brokerage account. Therefore, this is the way of trading we follow, and we also advise in our opinion videos. Of course, you can take it or not. It's up to you. But if you like this way of analysis, the idea here is that we look at the daily charts. We spend a little bit longer time. We don't do any stop loss, but we still exit with a profit because we buy non-linearly through those principal channels. And speaking of buying non-linearly, what does it mean? It means that we buy with different amounts, different channels. So here it will be classical buy, meaning that we play with 5 portions. So you can split the money you would like to play here in 5. Then you can buy with 1 portion through the first channel. Through means that you start buying at the top of this channel with those 1 portion and slowly buy it through until this first portion is completely used. And then if the first technical channel is not confirmed, then we go to the secondary one. And then you take 2 portions and you start buying with those 2 portions through the second channel, in this case between 12.57 to 14.27. And if suddenly any negative catalyst kicks in, you buy with remaining 2 portions in the last channel, while others will be exiting with losses. You just buy more and you still exit with the profit. So it's a bit controversial statement, but it is indeed the case. With this way of trading, the worse it gets, the better for you in a certain way, because you will be buying more cheaper. Then you can, of course, spend a little bit longer time, but you exit with more profit on a bigger amount of money. So this way of trading is very risk mitigated, very safe in that sense. And the idea is once all risks are mitigated, what remains for you is just to take the profit. So if you like this way of trading, if you like this philosophy of non-negative trade, non-stop loss trade, please don't forget to subscribe to our channel, follow us, press the bell button. This way you will not miss our new videos and new interesting discussions for US-based stocks. And with this being said, this is all for HGEN. Good luck with this one. Stay tuned and see you at another episode of Stocks Advisor channel.